Hello everyone, I'm Miles. I'm very glad to have the opportunity to discuss with you again the very important balance sheet in modern finance. There are some key concepts in the balance sheet that need to be highlighted. For example, what is an operating asset? What is a non-operating asset? Why do I bring this up? Because whether you're working in investment banking, corporate finance, or at a private equity firm, most of the time you need to remember this. It's about working capital. Actually, it refers to operating working capital, meaning the type of working capital related to operations. For example, what is a common operating capital item found among current assets? Accounts receivable, right? Accounts receivable, inventory, and prepaid expenses. Prepaid expenses are payments made in advance. So, among current liabilities, what are the main items related to this? Accounts payable, which is what you owe to suppliers. Accrued expenses, which are accumulated expenses, and things like deferred revenue, money you've already received but haven't yet delivered the service for, and so on. All of these count. Operating current liabilities. Why is this so important? Because when we talk about working capital, what are we usually referring to? We're talking about short-term accounts, short-term liabilities, and short-term assets. So the formula we get is O working capital. CA right? Current assets minus current liabilities. But often in investment banking, what we actually look at and consider is OWC, operating working capital, or sometimes it's simply called net working capital. These different names actually refer to the same thing. This, in fact, refers to the operating related working capital, short-term assets minus short-term liabilities. So let's take a look at this process. What exactly is OWC? OWC, we can calculate it, and actually, it's pretty simple. Just add up 180. Add 320, add 70, then subtract 400, add 180, and add 120. If you do the math, punch it into a calculator, you'll see it comes out to negative 130. At first glance, negative 130 might seem like a bad thing, but it's not. When it comes to operating capital, this is important because it's directly related to your operations. But it's not about cash. So, other things being equal, you want your OWC to be as negative as possible. Why that? You want your accounts receivable and accounts payable to be as low as possible. Why? You want revenue, sales, to be cash transactions. You want to receive 100% cash. You don't want to wait 30 days for your first installment, then another 60 days for your second installment. No, you don't want that. You want your accounts receivable to be as small as possible. The smaller the better. You want the amount you have to pay out, your accounts payable, to be as high as possible. For example, take Walmart. They want to pay their suppliers, like Pepsi or Coca-Cola, as late as possible, ideally dragging it out for 365 days before paying, with zero interest. So in this situation, you can see that this is actually closely tied to your cash, especially your cash flow, because in reality, cash flow is the lifeline of a business. So, as you manage things like accounts receivable or inventory, these become less and less, and as you look at your liabilities increasing, it's actually a good thing for your cash. What does this mean? It means that most of your revenue is received in cash, okay, while most of your accounts payable or accrued expenses can be postponed for later payment. Of course, there may or may not be interest involved, but other things being equal, you want to pay bills as late as possible and collect receivables as early as possible. That's why we'll discuss cash conversion cycle, CCC, later. But for now, we're considering OWC. The cash flow from operations is very closely related to this. This is somewhat in line with the intuition from accounting, which basically means that, in reality, the lower your accounts receivable, the better, and the higher your accounts payable, the better. In other words, if your OWC itself keeps decreasing, for cash CFO, cash flow from operations, it's actually getting better and better. You can think about the logic behind this. Basically, if your AR decreases, it means your cash is increasing, right? Cash flow from operations goes up. Because all your sales are being collected as cash instead of as accounts receivable, there's no delay in payment. If your account payable keeps increasing, then your CFO, your cash flow from operations, will also increase because your cash can go into CFO, and you can pay later. You can even default, because your account payable is increasing, other things being equal, okay? So logically speaking, if your operating capital is decreasing compared to the previous period, your CFO. In fact, your cash flow from operations will increase. Operating will go up because the proportion of cash is increasing, and the cash you actually receive is also increasing, other things being equal. Alright, so in today's talk, even though we didn't do any exercises, I hope that after this lecture, everyone can answer these three questions very clearly. The key point here is that OWC is a part of liquidity, okay? It reflects the reality of whether your operations are actually turning into real cash. Okay, because cash is king. All else being equal, companies always hope that all sales are in cash. Okay, companies also always hope that accounts payable can be postponed indefinitely, all else being equal. Okay, the longer the better. The more accounts payable, the better, right? All else being equal. That's all for today. I hope everyone now has a very clear understanding of operating working capital.